So this tweet from Douglas A. Bonaparte, it pretty much sums up everything we're going to go over today in this video. The 60-40 portfolio remains undefeated. 60% losses, 40% more losses. I don't know about you, but I think that's pretty funny. This Douglas A. Bonaparte, by the way, you should follow him on Twitter. He's got a hilarious Twitter account, always talking about and making jokes about what's going on in the market. And I know, by the way, a lot of people are hurting and it may not be funny to you, but this is a positive YouTube channel. I am an optimist. I'm always trying to be optimistic and positive about what's going on in the market. And I know if you were in 2009, for example, and you were investing and you were in the gutter, well, guess what? It wasn't a great time to be a pessimist because that's when everything bottomed. Will that happen right now? I have no idea, but I just know that it's always good to be looking at the positives about what's going on in the market because most people have been rewarded when they do that. Let's go over this chart from Charlie Bolello. However, I do want to make sure that you all understand because some of you are kind of newer investors. So what is a 60-40 portfolio? Just quickly, it's basically when you have 60% of your entire portfolio inside of stocks or equities, and then the other 40% go into the bond market or fixed income. That's a 60-40 portfolio. That's what we're talking about today. It's a very popular mix of stocks to bonds that a lot of people have. A lot of people who are retired have this. A lot of people getting ready to retire. So it's supposed to be a safer bet than having all of your money inside stocks or equities. And that being said, let's see what happened with the 60-40 portfolio lately because it's not good at all. So here we have the tweet from Charlie Bolello, and he says, a mix of 60% S&P 500, 40% US 10-year treasuries, and these are returns going back all the way to 1928. And if you know anything about history, that's when the Great Depression was starting. So if you look at this entire time period, we're sitting right here, negative 20.4%. Okay, what was the worst time period for a 60-40 portfolio since the Great Depression? Well, the Great Depression was the worst at negative 27.3%. And guess what? We're at the second worst. What this is saying is if you have a 60-40 portfolio, you are down worse than if you had a 60-40 portfolio in the Great Recession in 2008, in the tech bubble. Nothing has worked for the 60-40 portfolio this year. It has not performed well. Very unfortunate for those who are invested in that type of portfolio. Let's go to the next slide and we're going to show you why. So basically, bonds are supposed to be less correlated to the stock market. At least generally, that's how things have gone recently. And when interest rates essentially were not increasing like they are today, apparently right now, and there's no inflation, that's what bonds have essentially been doing. Now, this is correlation between stocks and bonds. So when you get these higher numbers, it means that stocks were more correlated to the bond market. And when you get these lower numbers, it means, let's say stocks were maybe even inversely correlated to bonds. So if bonds go down, stocks will go up, and if stocks goes up, bonds go down. So whatever, you know what I'm saying. They're inversely correlated. They do the opposite of each other. So negative 0.64, for example, would be that the correlation maybe is probably actually inverse, right? Now, when it's higher, let's say 0.78, there's a correlation that's much closer. So if a stock goes up a certain amount, bonds might still go up a certain amount. But if it's inversely correlated, maybe when the stock goes up, bond actually goes down a bit, okay? And when in 2008, the stock market, when it fell so much, the bond market didn't. It actually held up. It was pretty resilient in that time period, interestingly enough. So let's take a look at 2008, 2009. There was correlation, and you could see it jumped up here. But again, the correlation was not that high. Well, it was high, but it wasn't that high, 0.4%. Over here, take a look, and 0.70. We're at one of the highest correlations that there's ever been between stocks and bonds. And that's why owning bonds aren't necessarily shielding you from the decline. Bonds and stocks are kind of trading together. Let's put into context where we are right now with interest rates because that's important for this video. Now, this is actually something that I showed a couple videos ago. So Jeroen Blokland says breaking the Federal Reserve hikes rates by 75 basis points. This was back when they hiked the interest rates last week. But basically what we're looking at is the Fed funds target rate. And what we're doing is we're saying, okay, how has this looked over time? And you can see it's very high over here in the 70s when there was a lot of inflation. And basically they had to hike interest rates to try to combat that. And as time's gone on, you've seen that this downtrend line going from essentially the Fed funds target rate to 5.25% in 2008 period, which is when they slashed it because of the Great Recession and they went to essentially zero rates. And since then, it's been essentially nothing, and then they've slowly crept back up. And that's what you would expect to happen from the Federal Reserve in a normal time period. They don't just like suddenly increase interest rates extremely fast, but they did that this time. And you can see that here, the slope of this line is so slopey, it's so high that we went from pretty much 0 to 3.25%, and that's the issue right now with the bond market. It's too fast. It's almost too fast, and bonds are not reacting well. And so when we look over here at the fixed income market dynamics, this is kind of an interesting chart that's going to show us what increases in interest rates can do to bonds. So these are different durations, let's say. So you have a 2-year bond here. You have a 5-year, you have TIPS, you have 10, you have 30-year, okay, U.S. aggregate. Okay, so these are all different types of bonds you can have, fixed income that you can have. And then this is, the blue is when interest rates fall, and then the gray is when interest rates rise. So what happens to the 2-year treasury? So when interest rates rise by 1%, the 2-year treasury will go up by 1.6%. Now, if interest rates fall, then bond prices will go up by 5.4%, right? So this is what we're looking at here. We're looking at the differences. So now, again, remember, right now, interest rates are going up. So interest rates going up, let's go to a little longer duration. Okay, you have a 30-year U.S. Treasury. Well, that 30-year U.S. Treasury, just by going up 1%, can tank the price of that Treasury by 13.3%. And this is what's happening. Increases in interest rates are leading to lower prices of bonds. And so if you have a bond fund and it has longer duration, let's say, it's probably going to be hit more. Or if you have a shorter duration bond fund, it's going to be hit less, essentially. Now, this was tweeted out from Jim Bianco at Bianco Research, and he's saying, summing up, the global bond market has lost over 1/5 of its value this year. Before 2022, such a move was thought to be impossible. Note that this index is priced in dollars, and within 53% of its index is foreign denominated bonds. The strong dollar is killing it. And so you can see here, this is down negative 20.3%. And these are all different years. So what you're looking at here is all these little, we'll call it spaghetti noodles. Each of those is a year. So here, 1995, the best year was up 19.66%. The global aggregate index was up 19.66%. And here we are, the lowest, the worst out of all this time period, going back till 1999. That is not a good sign, of course. We don't want to be in the worst bond period price-wise, price decline-wise since 1990. What he's saying here is that this aggregate index is made up of all different types of bonds, and it's a global index, and 46% of it is the U.S. The other parts are actually Asia-Pacific and pan-European. So let's say Europe and Asia are the other parts of this, the other main components of this. And so if we go to this other one, this is different. This one's looking at the U.S. aggregate, not globally. So U.S.-wise, we are still the worst year. Again, the best year here is 1982. This is actually going back further to 1976. So the best year for bonds was 1982, up 32% for a bond fund for the U.S. aggregate index. But again, down 14%, the worst year since the 1970s that we've seen. This is actually not down as much as the global aggregate because the US actually isn't as bad as Asia Pacific / Europe. Imagine that, right? We are down 14 point something percent in the US, but we're actually not down as bad as some of the other countries. Here's a tweet from Wall Street Jesus, 60/40 portfolio down the toilet. What this is showing us is just different regions in a 60/40 portfolio equity bonds, right? So the other one, we were just looking at the aggregate bond funds. Now we're looking at what's going on with the 60/40 portfolio in different regions. So Japan's actually held up better than the US and Europe, which the two blue lines are US and Europe. And as you can see, US and Europe, they're basically the exact same, down the toilet. We're trading together, and it's not a good time to have a 60/40 portfolio in Europe or the United States, go figure. And so over here we have kind of the kicker of this whole thing, unfortunately. So Bank of America Research Investment Committee, they say bonds don't hedge equities in an inflationary world. These are rolling 24-month correlation between stocks and bonds. So they're saying what's the rolling percent gain or loss over a 2-year period. And we're looking at that now. And this is what's going. Bonds and stocks move together. So bonds hedge equities here. And remember, what's happening here is that interest rates were going down. There was no inflation, right? Well, inflation was very low, and interest rates were going down. So inflation's down, interest rates not going up, And here you have inflation going up, interest rates going up. And what ends up happening? Well, remember I was talking about bond correlation to stocks. Well, they're correlated more when there is inflationary environment. So when it goes to 0.4% or 0.4 is a correlation between stocks and bonds. And that's not good if we're trying to hedge against stocks going down by using bonds, right? So it's not going to work well when they're pretty highly correlated in inflationary environments, which we're in right now. Okay, too much negativity, people. Gotta end this on a positive note. I always try to do that. In these types of videos, when it's talking about markets, they're totally not doing well right now. So here's some positive news. So here we're looking at target Fed probabilities. So what are the probabilities of getting to a certain interest rate? Remember, we're in an interest rate environment where that's going up, right? So as interest rates increase more and more, it could be worse and worse for your bonds, your 60-40 portfolio, right? Because it's not going to be good for the fixed income part of it and also for stocks, honestly. And so here we have how probable it is that the interest rates go up to 350 to 375 basis points, which is 3.5% to 3.75%. Okay. There's a 44% chance, and then there's a 55% chance it goes up more to about 3.75 to 4%. And this is as of November of this year. Now, let's say, okay, when do interest rates stop going up a lot? And so that's kind of what we want to know, because we know if interest rates stop rising a lot, that it could be good for the bond market, right? Well, maybe inflation, it also means inflation will be down because hopefully the interest rate hikes will battle inflation and inflation will come down. That's what would be nice. And so if we come over here and we take a look, let's go out to June of next year, 2023. So we're looking at June of 2023. Well, now the probability is 38%. It's basically split between about 4.25% and 4.75%. So between that range is where they're thinking we're going to end up. And so if the Fed ends up hiking to those levels, let's say 4.75% at the most, well, maybe they get there by the first month of the year, right? And so that would maybe mean 2023, start of 2023, maybe interest rate hikes would stop, right? And so maybe the Fed would stop hiking so quick at least. Now let's go even further out. We were looking at June. Let's now look into November of next year, November of 23. And so look, we're still there with 34% chance of being at about 4.50%. So this isn't set in stone or anything. These are probabilities and they change all the time. But this is what people think. This is probably what the market thinks. So basically we only have a little bit more to go in interest rate hike terms. Maybe this will be done in the next few months. And if that happens, maybe the 60-40 portfolio will not be doing so bad. And that is all I have for this video. I hope it helps. I hope if you were scared about what's going on, maybe this last part is going to help you feel a bit better about this. I don't know. I feel a bit better by seeing this and thinking about maybe interest rates at least slowing down the hike in a few months. That could be a good thing. Anyway, that's all I have. Leave a comment below. Let me know if you agree with me, if you disagree with me. If this was helpful, I'd love to hear from you. And by the way, hit that like button. Subscribe to see more videos like this awesome video that I hope you really enjoyed. And I'll see you in the end screen when you hit that video right now. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.